The live price for Moderna Inc., or mRNA, on the Nasdaq is $23.75, marking an intraday change that is positive, showing a move of plus $0.19 or plus 0.80%. Now that's the ticker, the number, and the immediate movement, but here is the unexpected reality of the situation that most retail investors, perhaps those relying solely on an individual brokerage like a basic Robinhood stock trading account, are likely missing. Moderna just delivered a colossal earnings beat on the bottom line, reporting a loss of 51 cents per share against a consensus forecast of a loss closer to $2.05, a difference of nearly fourfold. The immediate market expectation, especially from those who have watched this stock relentlessly decline from its pandemic highs, was for a bloodbath, another quarter highlighting the collapse of COVID vaccine sales and the struggle to diversify the business. The reality, however, is that this massive beat on the net loss figure has absolutely nothing to do with new product strength or a sudden surge in demand. It is a direct consequence of exceptional, aggressive financial discipline and cost-cutting that is truly what has the institutional players interested and what should force a fundamental rethink for anyone considering invest online opportunities in the biotech space. The market's common belief is that Moderna is a one-hit wonder, a speculative bet whose massive valuation was propped up entirely by a temporary global health crisis, and that now the company is destined to slowly bleed value as its cash reserves dwindle and its pipeline struggles to produce the next blockbuster. This narrative is too simple, and critically, it's missing the forest for the trees. The recent stock movement, this move up despite a general consensus of weakness, is entirely about that cost control narrative. When a company posts revenue of $1.02 billion, which itself beat the consensus but still had a sharp year-over-year decline in product sales, the focus immediately shifts to the burn rate. Biotech is a capital-intensive sector. Cash is the fuel for research and development. What the CEO and CFO have executed is a quiet strategic pivot to financial austerity. They've tightened the ship to the tune of a $700 million improvement in expected 2025 operating expenses and are now guiding for a year-end cash and investments range of $6.5 billion to $7 billion, an increase from previous guidance. This is a monumental shift in perception. It moves the conversation from how long until they run out of money to how much runway do they have to let their deep pipeline mature. For firms that utilize sophisticated intelligent portfolio strategies or operate as a high-level fidelity brokerage, this financial repositioning is arguably more significant than any single Phase 1 trial result. It completely changes the calculus on the company's long-term survival and ability to fund the costly late-stage trials. The trading volume surge post-earnings confirms this. It's smart capital realizing the floor of the company's valuation has been significantly raised not by sales but by management's execution on costs. When you analyze the daily swings, the stock's proximity to its 52-week low of $23.15 shows just how much pessimism was already baked into the price. The small gain today, while modest in percentage terms, is a massive vote of confidence given the context. It suggests that this deep valuation trough, which saw the stock trading near year lows in the run-up to earnings, was a technical signal that a rebound was due on any remotely positive news. The institutional activity, which we've seen in recent filings, points to a subtle accumulation phase by large investors who understand that the primary risk to Moderna stock, the massive operational losses post-COVID, is being managed aggressively. It's a classic value play in a growth stock uniform, where the cost structure becomes the hidden asset. This kind of nuanced trading behavior is something that traditional online investing advice often overlooks, favoring instead the headline-grabbing clinical trial data. The macroeconomic pressures of inflation and higher interest rates have been particularly harsh on unprofitable growth stocks, especially in biotech, making this focus on financial discipline not just a good idea, but an absolute necessity for survival. The core business of Moderna, the technology that still commands a huge premium over its recent earnings, is its messenger RNA platform. The success of the COVID-19 vaccine, Spikevax, proved the platform works and can be scaled, but that was just one molecule. The company's true value lies in the breadth of their pipeline across infectious diseases, oncology, and rare diseases. They are not just a vaccine company, they are an mRNA platform company. The main criticism has always been the single product revenue dependency. That is why the market is hyper-focused on non-COVID developments. They have a commercially approved RSV vaccine, mRESVIA, though sales have been minimal so far, showing the competitive heat from rivals like Pfizer. Their combination flu-COVID vaccine, mRNA-1083, is a critical near-term product, currently under regulatory review in Europe and awaiting guidance in the US. This is where the tension between expectation and reality becomes most acute. The expectation is that their next big product will be another quick-win vaccine. The reality is that the potential for long-term transformation lies in their oncology pipeline, specifically the personalized cancer vaccine partnered with Merck, which is in late-stage trials for melanoma. If that trial is successful, it fundamentally changes the company's narrative from a vaccine supplier to a leading cancer immunotherapy player. This potential is a multi-billion-dollar opportunity, a much stickier, high-margin market than seasonal vaccines. In terms of future outlook, there are three clear scenarios. The first and most positive is the platform validation scenario. The combination flu-COVID shot gets a clean approval and a strong commercial uptake, proving a viable recurring revenue stream, while the melanoma vaccine trial hits its primary endpoints. This would send the stock soaring past its year highs, validating the entire mRNA platform thesis and justifying its high science valuation. The second, the muddle-through scenario, which is the current base case, sees slow but steady progress on cost cuts and incremental sales from new products like RSV and the seasonal flu vaccine, keeping the stock range-bound but removing the immediate insolvency risk. This is the scenario that makes the stock a difficult trade, but a solid long-term investment hold for those with patience. The third, the pipeline failure scenario, involves major late-stage trial failures, particularly with the cancer vaccine, combined with continued low uptake of new commercial products. In this scenario, the cost cuts, while impressive, would only slow the descent, leading to a much more difficult road ahead. The fact that the stock is moving up on a cost reduction story, even after the recent disappointment of the cytomegalovirus trial failure, shows that the market is valuing financial prudence highly right now. The CMV trial not meeting its primary efficacy endpoint was a serious clinical setback that normally would have cratered a stock, but the financial beat mitigated the damage, proving that for those of you managing your own retirement accounts, maybe through a service like Schwab Intelligent Portfolios or the various Fidelity ETFs and Fidelity mutual funds, the mRNA situation highlights why biotech investment help should focus on clinical execution combined with financial stability, especially when a company is still operating at a loss. It's not enough to believe in the science, you must believe in the management's ability to steward capital. The company's large cash pile gives them flexibility, a massive advantage over smaller biotechs. They can aggressively invest in R&D, pursue potential partnerships, or even engage in share repurchases, all without immediate shareholder dilution. This is a crucial, non-clinical value driver. Look at companies like Tesla and Nvidia. While entirely different industries, their valuations are built on both disruptive technology and the ability to scale and control costs effectively. Moderna needs to execute on that second part now more than ever. Their strategy now is less about a single product and more about proving the industrial scalability of their entire technology. The focus now shifts from the Q3 report to the Analyst Day and upcoming milestones. Investors need to watch for any regulatory guidance from the FDA on the flu-COVID shot, which could be a significant near-term catalyst. The market will be scrutinizing the enrollment and interim data for the Phase 3 melanoma trial with Merck. It's the melanoma trial, not the seasonal vaccines, that holds the key to the next step change in valuation. If they can execute there, the stock will re-rate completely, moving out of the pandemic stock category into a pure-play biotech leader. But if that partnership falters, the bear case gains substantial momentum. This all feeds back into the expectation versus reality framework. The expectation is low. that they are only a COVID stock in decline. The reality, which is driving this modest stock appreciation today, is that their cost discipline is extending their runway, buying them time for their deep and valuable oncology pipeline to potentially bear fruit. This delay in the inevitable, if the bears are right, or the extension of time for the transformative assets to succeed, if the bulls are right, is what the current stock price action is all about. The question is, how long do you wait for a pipeline to succeed? The management just answered that by buying themselves, and you, more time with their aggressive expense reduction. That is a tangible asset right now. Comment below how many shares of Moderna mRNA you currently hold, or if you've decided to sell off your position recently, and why. Your position will likely reflect your expectation of how the